Hello everyone, welcome to Accounting for Managers. In today's video, we are going to learn how we can analyze business transactions. So, in the steps of accounting cycle, we had discussed the 8 steps of accounting cycle. So, those were identify. First, we have to identify our transactions. Once we identify the transactions, we need to record them, then post them into a ledger, create the trial balance, analyze the worksheet, and adjust the journal entries if required, and create financial statements, and then close your books. So, when we say we have to analyze business transactions, it just means that we are trying to identify the business transactions. So, our accounting cycle actually begins with analysis of business transactions. Now, with the proper analysis of business transactions, we can ensure that our recorded entries, which gets processed further, which moves further in the accounting cycle, is recorded properly, right? It is correct. So, the analysis of business transaction actually involves 4 steps. First is we have to ascertain the accounts involved in the transaction. So right now, most of us, we are following the double entry system of bookkeeping. So in that, it will have minimum of two or more accounts involved per transaction. So first and foremost step in the analysis of business transactions is that we identify or ascertain which are the accounts that will be affected by this transaction. And then we need to ascertain the nature of these accounts, that is whether these accounts will be debited or credited. And then we will determine the effects, whether this debiting accounts value is going to increase or whether it is going to decrease. Okay, and once we identify that, we can apply the rules of debit and credit. So what are the rules of debit and credit? All these things we will find out in another video. Okay, that is planned. It will be released shortly. But for now, let us just have an overview of all these steps. Okay, so ascertaining the accounts involved. So as I said, every business transaction, it involves at least 2 or more accounts. Like for example, let us say that Mr. John here, okay, he starts a business with a cash amounting 2,000 rupees, 25,000 rupees. So what are the 2 accounts? You would think that there is one Mr. John account, right? And with a cash account, but no, that is wrong. Okay. So this, why? Because we have to think in terms of, what you can say, we have to think in terms of the business, right? We are following the business entity concept. Now there are 12 accounting concepts based on which we have decided or come to a common agreement on how we will record or analyze the business transactions. I had posted a video about the 12 accounting concepts earlier. I'll leave a link to it somewhere around in this video. Okay, so if you're not familiar with those concepts, that do check it out. Okay, and that will definitely help you understand the rest of the concepts we will be discussing in this series as well. Okay, so this 25,000 rupees is actually for the business a capital, right? Why is it a capital? Because this is the amount with which the business was started by Mr. John. Okay, so capital account, and then he had started it not with a bank loan or anything, right? He had started it with raw cash. So there will be a cash account. Okay, so these are the 2 accounts. Okay, so it takes a little time for us to actually properly identify the accounts involved and all these things. It comes only with practice. Some it may come naturally, but for most of us it will come with practice. I'll say my case, I really did have a quite a difficult time when I was starting learning accounting, especially because I did not come from a commerce background. I came from a science background into this, so it was actually very difficult for me to wrap my head around it. um but now things are much better after a lot of practice. Okay, so I'm sure you guys also will be able to master it with practice, and that is the reason why I've started this whole series, also because being from a non-commerce background, I know the struggles I had to go through. So I really thought that if someone really did some videos purely for making life better for the people who have come from the non-commerce background, it would be great. I couldn't find much videos like that. Okay, so that is the reason why I thought, why not I do it, so that at least some others will, not face the problem I faced. Okay, so moving ahead, ascertaining the nature of accounts. So once we identified these accounts, okay, we have to identify the nature of these accounts. So cash account, cash is actually an asset, right? It is an asset for Mr. John, right? So it is a asset, whereas capital is an owner's equity or capital account, right? We have three types of accounts, broadly speaking, when we are looking at it from the accounting equation perspective. That is a liability, a asset, and owner's equity. Owner's equity is nothing but the capital. So this cash account is an asset and capital account is a capital. Now there are two ways of looking at it as well. Since this cash account, whatever money is in this cash account came through this cash account, some you might think that this is a liability for the business because we're thinking from the business entity perspective, right? So we will get to it later on. Okay, we will not mix everything up in this video. Okay, slowly we will build up to that point where you will be finally able to properly identify what is what and how to apply the rules. Okay, no issues. For now, let us just understand that the second step involved is ascertaining the nature of accounts. Now we need to determine the effects in terms of increase or decrease in these accounts. Okay, so when Mr. John started a business with the 25,000 in cash, right? We had a cash account and a capital account. Capital account also, the amount increased, right? Now the capital is more by 25,000. Cash account also, money increased. How? Because Mr. John put cash into the cash account, right? So in this case, actually, both accounts, the actually, when you think about it, both accounts, the value actually increased. Now, applying the rules of debit and credit. Now, you will be thinking, okay, if both are increasing, then how can we say it is one is debit and the other is credit, right? Natural question. Even I had it. Okay, but the thing is, like for example, we most often think about debit and credit, especially when we are a newbie, in terms of perhaps a bank transaction that we do, right? We had some money, we had some cash in our hand, we went to the CDM, okay, cash deposit machine, or we went to the bank's teller and we gave them that cash to put it in our account. So the cash went from us, okay, and money in our account, that is bank, increased. So cash decreased, bank account increased. That's how we think. So we debited, cash account, bank account credited. Like that is what we will be thinking generally for debit and credit. That is the most crude, or that is the most common form of debit and credit that we have. But business transactions are actually way more complex than that. Okay, and depending upon whether it is an asset or a liability or an owner's equity, then the increase or decrease in those are what actually drives debits and credits. Okay, denoting whether it is a debit or denoting whether it is a credit. That is what actually drives all these things. And debit and credit, when we think of it in the terms of a simple bank account, is not what the entire term actually means. Okay, so we will come to all of those things in depth in the coming videos, and by the end of that, you will be able to identify the differences and apply the rules of credit while writing journal entries, okay, or ledger entries. Doesn't matter. So don't be scared. Okay, we will come to it, and by the end, I'm sure you will be able to understand this whole thing. Okay, so in this account, okay, cash account we said was an asset account. So when an asset increases, we actually debit it, and capital account, when it increases, we will credit it. Okay, so that is how we apply the rules of debit and credit. So in this video, my aim was mainly to help you familiarize with the 4 steps which are involved in identifying the transaction. After this 4th step, that is applying the rules of debit and credit, we are good to record these transactions in the books of accounts. That is, we are ready to move to the 2nd step in the accounting cycle. Okay, so this video was for us to identify the transactions, understand how to identify the transactions. We will do the actual identification and other related concepts in the coming videos. So I hope the purpose of this video was fulfilled and you understood how to analyze or how to identify business transactions. If it did, consider subscribing, because as we said, right, all these 4 steps we will be discussing in depth in the upcoming videos. So thank you very much and see you in the next video. Bye.